We're now sending our lenses, focusing our gaze on the economy as there has been that marginal increment in inflation to 21.5%. We're asking, what is accounting for this? Are we putting in the right remedial measures? And where do we go from here? Dr. Theo Champong joins the conversation. He is a political risk analyst. Doc, thank you so much for joining.
Very much. Thank you very much, and it's good to be here.
I should actually be saying thank you very much for staying, and thanks for those initial comments. But how do you think we got here, as far as this is concerned? And maybe before you even come in, if my team is ready, we should just walk through the facts and the figures, the slides we have, just to paint a picture before we start interrogating the issues. So we'll just get there, the few slides we have, walk through them. And then after we've done that, we shall come and look at what exactly has been happening so far. So from what I see here, you would know that we are contemplating an inflationary rate of 21.5% in September 2024. And this is the first time there has been an increment in 6 months. So for 5 months running, there was no increment. In fact, it was decreasing marginally, but it was still a decrement. But now there has been an uptick, and we have to interrogate what exactly caused this uptick. And you will soon get the feed so you can move along with me. But, and there you have it. So for the first time in 6 months. If we can go to the next slide, you would notice that this is food driven as well. The rise is driven by food inflation. You would notice that last month food inflation stood at 19.1%. This month it stands at 22.1%. That is an increment of about 3%. In fact, exactly 3%. And that is also pushing the needle. Non-food inflation last month stood at 21.5%. It has gone down now to 20.9%. So if you look at it, food inflation is one of the causes, if not the major cause of what we are seeing. Let's go to the next slide now. Then you would see that the prices of locally produced items are rising faster than imported ones, and that's also on the back of the cost of production and taxes and everything in between. Local inflation standing at 23.4%, while imported inflation stands at 17%. That's a difference of 6.4%. So it tells you that local inflation is biting as far as the economy is concerned. If you move on to the next slide, then you would be taking a look at selected items with high inflationary rates in September 2024. Then you're talking about fish from rivers. I don't know whether Galamsey has a role to play in this, but fish from rivers stands at 37% in terms of inflation. Herrings, smoked herrings, 45.2%, and this is something we all consume. Rent, 20.5%. Tomatoes, that is fresh ones, 56.9%. That's a worry because practically everybody uses it. And yam, 42.7%. Now, depending on whether you want afasia or puna, you would notice that the prices have shifted quite a bit. Then we'll move on to the final slide. That was the penultimate slide. So now the final slide. And then fried plantain and beans. Inflation there, 50.1%. Yokegari or gobe, as some people will call it. Kenke and fried fish, inflation 32.4%. Akpeteshi, akpet, 36.3%. Primary education, 30.8%, and public or private SSS or SHS fees, 38.1%. When you do the compilation, you see that it paints a certain picture, but food inflation definitely one of the causes. So now coming to you, Doc, when you look at these facts, these figures as put out, what do they mean to you?
It tells us that the process of disinflation, which we had seen the last couple of months, is just about to peak, right? So if you look at the data, and like you rightly indicated, for the last 5 or 6 months, inflation has consistently been coming down to around 20 point something percent with the last reading. It doesn't mean
I
that
think
prices are not.
20.04 or so.
Yes, it doesn't mean that prices are not rising, but relatively speaking, they are not rising as fast as when it was like 54 percent.
Right.
But particularly if you look at the Central Bank Monetary Policy Committee report and the last meeting that they actually reduced the policy rate by 200 basis points, 2%, off the back of the expectation that inflation was going to further ease going into the latter part of the year. And in fact, we've got a target of 15% for end year inflation. I think, and I've always maintained this, that it's going to be a bit difficult to meet that 15% target, especially given that the rate of that disinflation had not been as fast enough as we expected, even given the bumper right harvest that we had last month and the month before. And with this new reading that has come through, if you look at the change month on month on food inflation, that's about 4.2% change month on month. And then non-food is only 1.6%. So it still tells you that you've got a big pressure on the non-food component of the inflation basket, and with households still, facing a lot of challenges when it comes to food. And so I'm not surprised then that you see, like you said, Gobe and other things, picking up, momentum. And then also, when you look at it from local versus imported items, you again are seeing a bit bigger percentage rise on the local items, but relative to the imported items. So you've got, I think, 23.4 versus 17% on the imported items. So it still tells you that a lot of the cost factors, the business environment, is still having a major impact on businesses, and businesses are passing this on to consumers. Hence why the inflation has picked up, momentum again. I don't think that 15% is going to be met by the end of the year. And again, if you quickly look at even the breakdown, so if you disaggregate the September numbers again from the statistical service, you see that on a month-on-month basis, I think alcohol went up about 4%, and then food and non-alcoholic beverages also 4.2%, and then things like personal care items also went up 3.2%. So it's a big or varied mix, but the biggest driver really has been the local bit, and especially the food component of the inflation basket.
I see. Now, you talk about non-food inflation as well, though food inflation is causing the increment on the surface of it, as the legal people say, prima facie. But non-food is also contributing. So what does this mean? Does this mean that as of now, we should be expecting inflation to continue on a certain trajectory? Because if you look at it, though there's been a dip, if you compare the food inflation and the increment to non-food deflation, if you may put it that way, you would see that food inflation is higher by way of percentage, about 3%, in fact, 3 percentage points heading north for food inflation, and a decline of less than a point for non-food inflation. What does that mean, basically?
So what it means, and I think probably the worrying sign, if you remember, a lot of the people or farmers in the middle and the northern belt of the country have been complaining about the rains not coming for the last several months, right? And these are the major food growing areas or food basket of Ghana, right? So, and to the point that even the government had to intervene by providing, I think it was 500 million Ghana cedis or so to support these farmers. So what that for me tells me is that the inflation expectations would actually begin to pick up again going into the lean season. So we're just coming off the major rain-fed season where there was relatively some good food or a lot of food around, but not as much as we're used to compared to previous years because the rains didn't come and our agriculture is largely rain-fed. So as we actually move into the leaner seasons, starting November, December, January, February, I think that the inflation actually will begin to pick up, and you begin to see the food inflation component, still being relatively or persistently high. What that also then means is that we'll have to then supplement that with a lot of potential imports coming right through to meet people's needs, and therefore some of the inflation for the imported items would also begin to pick up. So overall, what that tells me really is that in the months to come, inflation will still begin to pick up and be relatively high and nowhere near the 15% that we're looking at.
You're saying that while government had projected 15% by close of year, if we are to look at this data and the projections you're making, is going to continue on this trajectory, and we shouldn't expect 15% anytime soon, at least not by close of year.
15% was the end of year target for this year on the IMF program.
Right.
There are a few other targets for 2024, which I don't have off the top of my head. But even that 15%, I think that probably we're going to meet it, if any, going to be way into the second half of next year. And for the few months to come, certainly as we are entering the lean season, less rainfall, less food being available, and the fact that even the food that we've had in this current bumper season has not been enough because the bread baskets of the country have not had enough rainfall. Inflation would still be on the high. So I think it could still move between the 22 to 24, 25 band easily.
Okay, you think it can move to 22 to 25 band. Just clarify for me. So you're saying that if we're going to hit about 15, for you don't see it happening. Did you mean second quarter? Because you said second half of next year, which would then mean from July. Did you mean second half of next year or second quarter?
Second half of next year, so from July onwards. So the 15% figure, the 15% target for December of this year, it would not happen, number one. And as we enter into next year, that target would be revised. And if the rains do come and there's a bit more food around, then yeah, we're probably looking at 15% from July onward.
Now, this inflation has a spiral effect. So when you look at the local inflation of 23.4%, which is 6.4 percentage points higher than imported inflation, what component, how much of it would you adduce to taxation and the cost of local production or the cost of raw materials?
Difficult to actually disaggregate just from the data. I have to do some further analysis. But clearly, what you see from the data is, yes, the tax component is an issue. But I also think the issue of transport, like, petrol and moving goods from the hinterlands to Accra and Kumasi and some of the urban areas, I would also, have an effect within that. But in terms of the broader disaggregation of, the extent to which taxes feed into that, difficult to give a precise number on that, except to say in broad terms that it is an issue. We've had our businesses complain for several years now. We've had Guta on this platform. I've sat with them. You've interviewed us, and you can see that the business environment still remains particularly challenging for a number of our entrepreneurs.
When you do the disaggregation, or at least you itemize them, fish from rivers, herrings, and all of that, these are concerns because you are looking at amani. I believe that those are herrings, unless I am mistaken. Smoked ones,
yes.
45.2%. That is pretty high. You look at tomatoes, another staple, another thing that we are using in practically all our stews, soups, and all that. 56.9%. Yam stands at 42.7%, and that is pretty high. But I'm also curious. There's akpeteshi in there. I don't know, and it's 36.3%. As for gobe, it has crossed the midway line, 50.1%. Then you take out, you bring in education, for example, primary education standing at 30.8%, and public or private SHS fees at 38.1%. When you look at these products as they have been, delineated, disaggregated, is there a picture? Is there a pattern?
Not necessarily. I mean, so you actually compare it to other previous months' readings, and you see some items persistently being high, other ones change relative, positions here and there. But it's also a function of the proportion or the weight of these items within the overall, basket of goods that we're looking at. For things like tomatoes, I probably am a little bit surprised, also because I think it was a few months ago that I was in your studio where we were talking about tomato prices. People paying 10 CD for like one or two, and it became a big furore. Subsequent to that, I have seen photos and videos showing a lot of glut of tomatoes within our market. But because it's a seasonal item, and for a very long time, we're not investing or doing enough to actually can the tomatoes or puree them and save some when you don't, when they are bountiful or plenty. It then has this cascading effect where if the tomato is not available because it's gone out of season, suddenly you begin to see the big spike or jump in the price. But consistently, the message from our inflation figures or readings over the last several years re-emphasizes the point that we need to do a lot more local consumption, local production, and then add value to a lot of our, staples, especially when they are in the bumper season, so you can, save some for the lean season where prices tend to be quite astronomical.
I would ask you about the gains we have made over time from the 50+%, that horrifying figure, highest in about 21 years that we saw. There's been a steady decline. But here's why I'm asking this question. If you look at the producer price inflation as of March 2022, it stood at 21.4%. Guess what? It is October 2024, and we're standing at 21.5%. You can go back, 2 years, and we seem to be in a little box. Am I misreading it? Or is it that maybe if you look at the inflationary trend and you also look at the practical cost of living, the needle hasn't moved much?
No, the needle actually has moved. So we need to disaggregate what the PPI does and then what the CPI does, right? I mean, for many people, the CPI, that's the core measure of inflation,
right,
not the PPI.
Right. But I brought the PPI in because when you look at the local inflation, for example, and you look at imported inflation, it comes to play. So what is the nexus between them? And is there any shift?
Yes, so the nexus it comes down to the inputs that these producers are using to manufacture their goods and manufacture their services. You've seen the exchange rate do whatever it was, although now it had some relative stability, you could argue, the tax issues that we've been talking about, the utilities issues that we've been talking about. All those things have a big consequence for businesses. What we want to see is to see both of those indicators, the producer price inflation and then the CPI, they should be going down. That is what you want. You want it to go down, and that then means that ultimately you're going to get more money, improve the welfare of businesses as well as consumers. And that has been challenging for several reasons. I think that the fact that we moved in the case of the CPI from the 54 now to 20 something percent, yes, you could say it's a positive, but it's still nowhere near, even compared to some of our regional peers, what they are doing with their inflation rate. A lot more can and needs to be done on the side of the fiscal authorities, and then on the monetary side, as well. Because what happens is that anytime the inflation figures or rate goes up, then the central bank has to react to that by trying to, curtail money supply, classic monetary policy intervention. And that then means basically the policy rate goes up and the cost of borrowing at the banks also goes up, and it affects businesses and it affects consumers.
Let me ask you this two-pronged question. So, and it's in one direction. How much of a factor does the exchange rate contribute to these dynamics we are seeing? Because we've seen where last time I checked, Swiss franc was over 18. We've seen where the dollar is pegged at, the euro, the Great British, or the British pound sterling as well. And juxtapose that with the Bank of Ghana's initiative, for example, with the gold coin, dowry gold, 1 ounce, half ounce, quarter ounce. I've heard the likes of Professor Bokpin say that it's not the panacea. It's not what will cure our problems in terms of the exchange rate and inflation. But when you put these two together, how do they merge side by side? And can they impact inflationary trends?
Yeah, so if you actually look at the literature and you look at what drives inflation and sort of unpack or disaggregate it in the country, of course, yes, exchange rate is one of the big factors in there, especially the fact that you have a lot of imported items, coming through. And even for the local ones, like your food, you still need petrol, diesel to fuel the cars to move them, right, from somewhere in the north to say Accra. So that's a big thing. The interventions that the central bank is trying to do, including this new gold coin, is one of several other monetary policy moves, right? So I think the idea is that instead of buying, for argument's sake, dollars, you could buy a gold coin and then sell off the gold or hold on to it, whatever you want to do. But it does not fundamentally solve the problem. It's a minuscule intervention relative to the scale of the problem because of the expectations, right? For many citizens, for many businesses, they would prefer to hold on to the dollar, right? Because they see that as a sort of safety and a retainer of asset value. Gold could help bridge that gap, but I think there's also a trust issue in some respect, given what we've seen. If you go back with men's gold and a few other things that have happened, a few years ago. So I don't think that it would kind of fundamentally shift the needle, so to say, in that respect. But it is one of several.
Did you just say you didn't think it? Did you just say you didn't think it would move the needle?
Yes, I don't think that the gold back coin or the gold coin that the central bank is trying to put would, push the needle that much when it comes to bringing inflation down through pushing people to actually swap, for example, dollars for gold.
I see. That means your reasoning is similar to Professor Buckpin's. What then can we expect? We're entering an election. People want inflation to come down. People want their pockets to be under less stress, less of a stretch, less pressure. If what you have said is anything to go by, that up to the second half of next year, July onwards, you don't see inflation coming down to the 15% as projected by our government in conjunction with the IMF. I don't know what that means economically, even as we go into the election. I'm just posing an interesting question to you. Does that mean Ghanaians should measure their expectations, or we all should measure our expectations ahead of whichever government we get in 2025?
Yeah, I've said on your platform and others that the 2025, whichever government comes in, we're still under an IMF program. There are still challenges with raising revenue. You still have a constrained fiscal space. From next year onwards, we'll actually even know the size of the spending, right, when it came to the election. Because historically, we've seen governments, try to spend or overspend in election years. Although my good friend and finance minister has said that they're going to stay the course, right? They're not going to overspend this financial year because you've got the IMF in town and all of that. The needle or the cat will be out by early next year, and those fiscal constraints are still there in that regard. And when it comes to ordinary citizens and things like that, I think the story is that the inflationary expectations would still be relatively high. That 15% target, of course, is actually set by the government together with its partners as part of the IMF program. But these are targets. These things change and they can be renegotiated at any point during the course of the IMF program. In fact, I'm expecting that as we go into early next year, probably some elements of the IMF program overall will possibly have to be renegotiated to accommodate the emerging sort of economic realities after the election.
Let's just do this. I want you've already started on that trajectory, but that recent town hall, we had our own finance minister, Dr. Amin Adams, speak to certain economic issues. I want us to watch that, and I'll come back to you with some questions.
Global happiness. Ghana, for example, was doing very well before this global happiness. We were growing at average 7%. Inflation was a single digit. Fiscal deficit was on target. But the good news is that we do not relent. And therefore, we have been implementing pragmatic policies which are bringing the economy back stronger. The rebound in our economy is well appreciated by our people who have suffered the hardship inflicted on us by this global happiness. And we are confident that sooner than later, the sacrifices they have made will bear fruits for the benefit of all of our people. Today, as I speak to you, growth ended 2023 at 2.9%, above the target of 1.5%. Inflation halved in 12 months from 54% by end of 2022 to 25% by April this year. And we are expected to move inflation further down to 15% by the end of this year, hoping to bring it back to a single digit by 2027. But this is at a huge cost to our people. because we have had to embark on huge fiscal adjustments.
All right, so that was Dr. Amin Adam saying that touting Ghana's economic laurels ahead of the global developments, COVID-19 and the Russia-Ukraine war. That's definitely what he was referencing. He says, we do not relent and we are going to bounce back. The economy is bouncing back stronger. He talks about growth being above expectation in 2023, for example, and he talks about the 15%, inflationary figure that has been targeted. He touts that again, and he talks about bringing it down to single digits. I didn't catch whether he said 2027 or 2026, but he talks about all of these things. How realistic are these positionings now, looking at how things are going?
Yeah, so I think we've discussed the inflation one, and
yes,
that the 15%.
That we've already looked at.
That's not going to happen. But I mean, there's some other positives which I agree with him on the growth figures, right? You look at the growth figures coming out the last quarter, the quarter before. It does indicate an uptick of economic activity and improvement in momentum at the macro level, which again is good. It's positive. It affects your GDP. It affects your debt servicing capacity, the fact that we've concluded all of the debt renegotiation arrangements and all of that, those things are all positive. The bit that I've always, as a matter of principle, disagree is the whole Russia-Ukraine COVID argument, which, again, on this platform and several others, the data shows that, Ghana is not an exception. Other countries suffered the same fate, but we took a bigger hit relative to them because of certain issues, because of the fact that there were some fiscal challenges, some not living, so to say, within our means, and a few other issues here and there. That I have always disagreed with government spokesperson in trying to attribute the cause of the crisis kind of solely to the COVID-19 and Russia-Ukraine. In fact, you even look at the IMF report that came out last year, and it says that there were existing fiscal vulnerabilities, and that is what really compounded the effect of the crisis. All that said and done, I am relatively optimistic. I think that the worst of the crisis is over. And in that regard, I align with what the finance minister was saying in terms of expectations for next year and beyond. And he says that single digit inflation is going to be 2027. That's a long time off. You've got 2 or 3 years to work on that, which is possible. Ultimately, all of this conversation is got to be about the Ghanaian. It's got to be about how we ensure that they are able to put food on the table and they're able to, support others that depend, on them. And that means doing our collective best, both on the fiscal monetary front, to ensure that the inflation goes down, there is growth, jobs are created, and those jobs or those growth actually translate into micro level gains. So we reduce poverty, you reduce inequality, and that has been my biggest concern in all of this conversation, that if you look at some of the inequality and the poverty figures, right, in the last 10 years, it's actually doubled, right? So from about 12% of the population that was being classified as struggling or call it poor based on the international poverty benchmark, now it's actually around 20-something% of the population. And the World Bank forecast that this could go all the way up to 33%. So almost 3 in 10 of our population, or a third of the population. that is the worrying thing, and that is what I think that a lot of the policy interventions that we see going forward ought to address. So it's not just addressing macro issues; they are important, but it has to connect to the micro to the extent that it helps to improve the welfare of our people and brings down poverty and inequality.
We'll be wrapping the conversation shortly, and shortly as well, we'll take you to Okponglo, the scene of the Free the Citizens and Stop Galamsey Now demonstration. But before we go there, my final bit to you on this. I believe the IMF is in town again. How do you feel we are faring as far as the IMF, supported program is concerned? And what would your expectations be by close of year?
Yeah, so on the IMF programs, we've actually done quite well. If you look at the quantitative targets, the structural benchmarks, and the conditionalities, the things that we need to do, we've met most of them. The last review indicated that we're done well. I'm expecting the current review, which is expected anytime soon, also to give us, a pass mark and release some additional funding for the country, which would all help in bolstering the reserves and supporting the CDS. So I think that, relatively speaking, on the IMF program, we're good. The biggest challenge was, of course, the debt restructuring, and that's kind of been addressed now. So the emphasis now is growth, 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 and growth that creates jobs, growth that reduces poverty, growth that reduces inequality. That is the biggest challenge that we've got to address.
All right. Before you take leave of us, Dr. Theo Acheampong, I just want to take us to those scenes there. If you have any reaction from what you see, you can share with us before we go. This is Okponglo, and there it is, the Stop Galamsey Now, Free the Citizens demonstration that is taking place. You followed the issue. You shared your reactions earlier. We're bringing the footage and the amassing up. The demonstrators there. And we see the Ghana Police Service also there to serve in full force as well. They are also on the scene. And my hope is that today there will not be any infractions and that everybody will demonstrate their thoughts openly, but within the remit of the law, and that no one will be picked up. But those are the scenes there. And you can expect that either on this show or later, in subsequent, shows or bulletins, will bring you the action on the ground. But Dr. Theo Acheampong, from what you're seeing, any reactions before we go? Those will be your final words.
Yeah, no, citizens have a right to protest. I just hope that it's done peacefully and there would be no confrontations and no sort of violence and people don't get hurt and all of that. But they have a right to be there to support the protest. I lend my support to the protest. If actually were around and had the opportunity, I would be there supporting them in the protest. But they have to do it peacefully and within the remit of the law. That's very important.
Doc, we're grateful for your time this morning. Nagode. And that is Dr. Theo Acheampong. He's a political risk analyst. You want to stay with us, there's still more action coming your way on the AM show. We'll be back after the break.